Welcome to the second event in our summer programme, Change, Challenge and Opportunity, where we're exploring the role of sustainability and ESG factors in shaping business over the next decade. I'm Claire Fraser, Head of Stakeholder Engagement at Emperor. Today's discussion is about disclosure in 2022 and beyond. In this joint event with ICAS, the professional body of CAs, we'll look at the evolution and future outlook for corporate and sustainability reporting, the convergence of financial and ESG information, the tightening disclosure standards, the changing world of the CFO, and the link between impact and enterprise value. We'll answer the most pressing questions we get from clients and provide practical advice to help you navigate the path ahead. So why are we having this conversation? Change is everywhere right now. From increasing stakeholder expectations around climate action, social issues and equality, new policies and regulation on technology and low carbon economies, to food and supply chain shortages, the impact of Russia's war in Ukraine and rising inflation. No brand or sector is immune. Sustainability commitments are now an expectation, not a differentiator. Innovation and new ways of thinking will be critical to address current and emerging issues. Specifically in the disclosure space, we're seeing increasing pressure on companies from the market, stakeholders and regulators, and the speed of change over the past 6 months in particular has been rapid. Mandatory disclosure requirements continue to increase, and key developments in the UK have centred on stakeholders and sustainability, particularly climate change. Voluntary disclosures driven by market and stakeholder expectations are increasingly becoming mandatory. Developments on the global stage have centred around the impact of sustainability matters on the financial statements, and the new International Sustainability Standards Board and the EU Corporate Sustainability Reporting Directive are both going to be game changers for corporate reporting. Investors are increasingly integrating ESG factors into their investment analysis and subjecting this information to the same scrutiny as operational and financial information. We promised you expert views from business leaders at the forefront of change, and our panel today includes Clive Bellingham. Clive is Deputy President at ICAS and Chair of the ICAS Sustainability Assurance Working Group. Clive is a Chartered Accountant and member of PwC's Global Board. Clive contributes to the governance and oversight of a network covering over 150 countries. For 40 years, Clive has advised global corporations and is passionate about helping organisations do the right thing. In particular, Clive is an advocate of diversity in business and sits on the board of Advance, a non-profit association set up by leading Swiss-based companies to increase the representation of women at executive level. We're also joined by Mark Bottomley, Chief Financial Officer at Cranswick. Cranswick is a leading UK food producer and constituent of the FTSE 250. Mark has been on the Cranswick Board of Directors since 2009, and in his role as CFO is responsible for overseeing the financial operation of the group and setting the financial strategy. Mark is also a chartered accountant with extensive experience in the food sector, having held a number of senior finance roles in the industry. We also welcome Brett Jacobs, Director at Radnor Capital. Brett leads the ESG advisory practice of Radnor Capital, an investor relations business that connects listed companies with providers of equity capital. Brett is a corporate broker and financial communications advisor by background, and he helps companies demystify the lexicon of ESG, understand how investor needs and expectations are shifting, and how reporting and disclosure can help to deepen the relevance of ESG considerations for equity stories. And last but not least, Jonny Mulligan, Strategic Advisor at Emperor. Jonny has international experience in financial reporting and equity and debt markets, including capital raising, IPOs and M&A. Jonny has been following developments in the UK, the US and Europe, and supports organisations to understand the pressure of downward disclosure driven by standards and frameworks, and to work through the future risks and opportunities that will impact valuations and profitability. Clive is our chair for today's discussion, so without further ado, Clive, ICAS has recently published 2 papers on sustainability. the necessary conditions for the reporting of high quality information, and factors to consider in relation to sustainability and assurance, both of which explore several important themes. Can you tell us a bit more about the findings and the key points you'd like to draw people's attention to?
Thank you very much, Claire, and good morning, everyone. As Claire mentioned, we at ICAS issued 2 reports this year. The first was in March, addressing the need for high quality information in the reporting cycles. And I'd just like to sort of address 5 specific points that we highlighted in that report. The first one being the increase in demand from stakeholders for increased transparency and accountability. And what's interesting here is that both of those areas support greater comparability, which is also a key factor to consider going forward. Second area I would like to highlight is financial reporting, which is primarily aimed at investors, is a long-established process with globally 2 key frameworks, namely IFRS and US GAAP. In contrast, sustainability reporting has a much wider audience and processes for and controls over many aspects of the reporting are not as embedded in organizations as those for financial reporting. The third area is an important consideration is of the connectivity between financial reporting and sustainability reporting. There's a need for boards and management to take an integrated approach to sustainability, in particular to link science-based targets for sustainability and the related financial impact. Fourthly, the reporting framework. As many of you will see in the ISSB, the International Sustainability Standards Board, was only formed in 2021. And this will need to mature and will need to also embrace numerous other frameworks that are within the sustainability reporting environment. And then there's the availability of expertise. Scarce resources is currently a challenge. But on the other side, it's also an opportunity for those who wish to build their careers in sustainability. So in summary on this report, there's a great deal to be done before sustainability reporting is as mature as financial reporting and fully integrated. The second report, which from ICAS's perspective was a very logical follow-on from the first report, was specifically to address assurance and factors to consider. This was a report we issued in May. And I think it's important to keep in mind that, what is the purpose of an assurance engagement, It's there to enhance the confidence of users in reported information. And in that context, key issues to be considered that we addressed in the paper are what is the sustainability information that needs to be assured? Because it could well be that not everything within the reporting environment needs additional insurance. Some aspects can be covered through other processes, such as through the internal audit cycle, for example. Which also leads on to the second point, who will provide the assurance? There's quite some discussion around that at this stage, and that will continue to evolve. But it's a key consideration for board and management when they're considering what to assure and who should assure it. And then there's a third aspect, which we at ICAS is currently considering taking a step further in what level of assurance will be provided. Because in the financial world, it's very clear on the level of assurance that's provided through the external audit opinion. But in the non-financial world, it's less than clear, frankly. And this is an area we're going to take further in due course. So those are the 2 reports we issued. I'd encourage you to take a look at those. But let's move on to my fellow panel guests. I'd like to kick off by asking them all a similar question. And I'll ask Mark to go first, followed by Brett, then Jonny. And that is, what are you seeing, experiencing in your respective roles? Because you all occupy different roles. And what's your view of the implications for the future of corporate, financial, and sustainability reporting? So over to you, Mark.
Just get myself off mute and make a good start. Morning, everyone. I think looking at the report that the two reports that Clive referred to, they resonate very strongly with the experience that Cranswick has sort of encountered over the last few years. We embarked on our second nature, as we call it, sustainability strategy, or relaunched it back in 2018. And in the 4 years or so since then, the pace of change has just been frenetic, both in terms of reporting, the number of reporting forums that you've got to line up against, and just the quantum of information and data that we are experiencing and trying to contend with. So I think that's the first thing. We set, and many businesses have set, sustainability targets and metrics. We signed up to, we have had our science-based targets validated and done a huge amount in the space. But I think the key piece, as we're talking about today, is the process we go through to validate those targets, and also to make sure that there is a roadmap to get us there. It's fine having a 2040 target, but what's the process to get there? And for many of us in business, it won't necessarily be us who are there to deliver or to say we've achieved those targets in 18 years' time. So it's setting out that roadmap and then making sure that it is very much auditable in whatever way you want to describe an audit, and that various stakeholders can buy into. So there's a huge amount that we are contending with, and that's an overlay onto what was the old day job as well. And quite often it does fall back onto the finance community to make sure that the data is valid and everybody understands it.
Thanks, Mark. Thanks for that. So, Jonny. Oh, sorry, that's my mistake. Caught you out there, just testing. I meant to go to Brett next. Sorry, Brett.
Brett, you go.
No problem. Yeah, thanks, Clive. Yeah, and good morning, everyone. As Claire introduced me, Radnor Capital, we stand at sort of the intersection between companies and investors. So we help companies to understand how markets are changing, but also we speak across the market to investors. So we also understand how market expectations are shifting as well. So what we do is try to sort of knit together those changing expectations, those changing needs. And what I find fascinating is the broadening of expectations that the market is asking of companies is really changing the way that markets present themselves. That companies present themselves to markets. It's I mean, the two reports that Clive mentions are very good at framing how markets are changing, and how companies are having to broaden the sort of the data points and the metrics that they use to justify not just the how companies are investable today, but how they will remain relevant as broader sort of themes that cover all of society and are changing the way society operates are changing. So it's a very interesting report to read, and I'd encourage everyone to do so. A few observations that we have from an ESG perspective is that ESG considerations are material to business risk. That's the fundamental thing, and so they sort of build around financial metrics and the established sort of frameworks that markets are used to in terms of assessing risk, assessing how companies are investable. So it's, while on the one hand, companies may feel that they are sort of drowning in a sea of choice in terms of these new sort of frameworks and standards and guidelines that they're being asked to integrate into established financial frameworks, we see it as an opportunity to actually present a more compelling investment case, more thoroughly sort of integrated into the broader purpose of a business within society, because it's all about helping investors to understand how a company can remain sustainable and part of the solution to societal problems that we're all having to navigate now. So while most of these frameworks and standards have voluntary origins, we're increasingly seeing them brought into a regulatory framework. And in order to do so, in order to sort of quantify these quite qualitative issues, it's going to be incumbent on regulators to provide these sort of guidelines in as close to financial terms as possible. So as investors themselves are working out how to research and assess companies in more quantitative terms, it's incumbent on the companies to adopt those frameworks and guidelines ahead of them becoming regulated, so that they can actually stand apart from the competition. Because there's nothing fundamentally different in terms of ESG considerations versus financial considerations. It's just that the market is more nascent and needs to grow up and mature in regulatory terms. But there's opportunity in looking closely at these voluntary frameworks as they currently stand, because investors are using that to differentiate companies and justify why capital allocates to one company versus another.
Thanks, Brett. So this time, Jonny.
Great, thanks, Clive. Great to be here. Thank you, everybody. So, look, what I do day to day is I talk with people like Mark, who are CFOs who are trying to get their head around this, and talk with investors as well who are trying to get on the other side. Now, I think I'm delighted that you referred to science-based targets, Clive, because that to me is the absolute key. Because I think when we look at where we are today, May and June of 2022, we're going to look back and say these were historical in terms of ESG and the development of this market. Because if you read it out, we first had the big HSBC speech, which brought loads of attention to the way that certain sectors of the financial industry are looking at this market. That was a very technical speech, but it actually brought a lot of light to how are we approaching, and if we really want to solve climate, carbon, biodiversity, and social issues, are we using the right tools? For me, and from my experience of working in this industry for a while, the problem to date has been ESG ratings. Now, before, when I would have been doing sort of sustainable or green bond listings, how it would work is, a ESG ratings agency would phone up and say, we're going to issue a ratings on you. You go, oh, can I engage with you? And there's a fee, and then you get a piece of paper that say you've got an ESG rating. What the market and what regulators and what the litigation, all this greenwashing litigation we've seen recently, pulling in Goldman Sachs, DWS, BNY Mellon, what we're seeing is the market and the regulators are starting to say these ratings are not delivering impact, right? And that's the moment that we're at now. Where I think it gets interesting, and why I like the two ICAS reports, and indeed the work that IFRS are doing, is because there's an iterative approach. The big challenge we have at the moment is, how do we put the science together with the finance? How do we make that logical for someone like Mark and his team in the CFO suite, how they can report to their investors saying we're doing the right thing, we're ticking the right boxes? That's the biggest challenge. It's not going to happen overnight. I think it will take 10 years before we get all the standards in place, and it's going to be step by step. But it's a key moment that is really, I feel, a starting point that we start getting ESG right. We tie to science-based targets, we use the standards, and we start driving value in the market. The last thing I'd say is, as well, because of all the compliance that's going on, what Brett and Mark have talked about, we've created this system which is essentially downward disclosure. So it's a bit like children's game of pass the parcel. So big finance is trying to get carbon, climate, biodiversity risk off their desk. So they're asking questions of smaller finance coming down to companies. So the level of interrogation for your disclosure is being driven by that. So it's like a big dragnet that, you know, companies and smaller cap investors are not going to escape. So what I would be advising is trying to engage and understand the standards and the framework is more important for now, because the level of questioning and speed will just continue to rise.
Great, thanks, Jonny. And Claire, you'll keep me informed if there's questions coming through the chat box, right? Thank you.
I will indeed. So the request that we had through was just to share the papers that we've been discussing. So we've dropped those in the chat box for anybody who would like some interesting reading over the course of the day.
Super, thanks, Claire. So Mark, earlier you touched on sort of, you know, the role of the CFO and how that is evolving with ESG and sustainability reporting, etc. And I thought it might be helpful just to dive a little deeper into that, both in terms of, you know, what are some of the sort of key strategic drivers that you've been considering, and then underlying that, you know, what are some of the operational process, people changes, developments, whatever, that in some ways are sort of consequence of the strategic choices and opportunities that this presents.
Yeah, okay. I mean, I think firstly, I would just to sort of echo the points that both Brett and Jonny made, and it is a hugely challenging and fast-moving area. So for businesses to stay on top of this, it's almost like another full-time job. But I think the key to this is firstly tone from the top, and governance is critical. We have introduced an ESG committee for our business, which sits alongside the other board committees, so the REMCO, NOMCO, and the audit committee. So you have that consistency of approach and board level buy-in to what's going on in the business. I think the other point is that this is something that resonates with so many people. We had huge buy-in from right across our, colleagues. We employ 13,500 people across the business. And when we launched Second Nature 4 or 5 years ago, or a relaunch effectively, the number of people who put their hands up to say, I want to be involved, was pretty profound, really. So people want and do want to make a difference. So it's really sort of joining that bottom up and what's going on in the business with the sort of board level oversight, and then trying to bring it all together against a backdrop of incredible number of standards, incredible number of areas to focus on as well. And as you say, pressure from numerous stakeholders who perhaps sometimes have slightly different agendas, whether it be investors, it be customers, it be suppliers, or it be regulatory bodies as well. I think the point about the ratings agencies that Jonny raised is an interesting one, because lack of consistency there is pretty noticeable. You can score very highly with one and score very differently with another. And you can, if you want to do, just take a full-time job trying to respond to all the questions from the ratings agencies at the moment. So that is a challenge. And I think piece of advice I would have is focus on what you're doing and have your own agenda and not be a slave to the ratings agencies. You do need to know what their thoughts are, but don't focus too hard and fast on that. I think the other point is that there is a real real varying levels of engagement between different stakeholders, and even within the same cohort of stakeholders. If you take investors, for example, some are much more tuned in already to this than others are, and you get a different view, particularly in the listed space, between the buy side and the sell side as well. So again, it's really doing what's right for the business, I think, is the most important thing. But from a finance perspective, I guess, and what I'm seeing in our business is, as I said earlier on in the conversation, is taking the big targets, the 2040 or the 2030 targets, and we've set some very challenging and industry-leading targets for our business. But then breaking it down into the roadmap, first of all, what are the yearly targets, the yearly progressions to get you there, and then also critical is how you measure. So it's about sort of doing exactly the things you would do in day-to-day finance, setting budgets, setting forecasts, measuring, and it's the data that is critical. So again, it's another stream of data and compliance that you have to overlay on top. And then secondly, on that data point is validation of data. Yeah, again, there's a huge amount of data to capture, and if you're not careful, you look in every business, some parts are better than others. So we now use internal assurance through internal audit to make sure that data is valid as well. Two things that we've done externally as well. One and I think this is where it starts to really bite and where the business buys into it, is linking it to remuneration, which is what we're doing from an executive level now, and also we refinanced recently, and our bank facility is sustainability linked. So we have targets which we are committed to from a banking perspective as well. And then that leads on to the banks then need external assurance. So again, our targets have been externally validated for the first time as well. So I think it's that sort of independence, both internally and externally, and then also linking these targets and metrics to real business scenarios, whether it be remuneration, banking, other things as well.
Thanks, Mark. Thanks very much for that. And listening to you sort of took me back to my early point about, the increased transparency which you're achieving by setting out the roadmap, making it clear where you want to get to and by when, and then having the underlying sort of processes, controls, accountability in place to sort of measure yourself against that and keep stakeholders informed of the progress, because as we said, it's a journey. So thanks for that, Mark. So turning to Brett, earlier you talked about value drivers, and we've seen a lot of, or I would say increasing sort of interest in the relationship between ESG and the value of your business, the enterprise value, if you want to use a technical term, right? I mean, I'm sure you're having a number of conversations in that area. It would be helpful, I think, just to share a little bit more about what is the current thinking there, and what are some of the value levers to be considered.
Yes, that's right. That's a good question. The discussions that we're having with every board really is what's material about ESG factors broadly, and how can you recognise and quantify that and integrate it within corporate strategy. And these are just as important questions that investors will be asking. The whole investment community, the general public, everyone is all too aware of these broader issues of climate change, ecosystem and biodiversity risks. How do you actually work within the financial markets to quantify that and integrate it into the investment case, so that an investment case remains relevant and not just supportable, but we might say also investable as well. These are really big challenges that rapidly can overwhelm a board. But I think that Mark's commentary and overview was excellent. He effectively sort of boiled down very quickly the key priorities that a company should focus on in order to ensure that the relevance of ESG factors are tied as close as you can within current regulatory and disclosure frameworks to the core investment case. And this is really what should be front of mind to any board. It's how do ESG factors explain and reinforce your equity story. Two points there. Firstly, if you're pulling together an ESG narrative that is separate and sort of sits alongside your corporate strategy, For a start, that's quite difficult to unpack in an integrated way with any one investor. You've got to go through effectively two difficult to connect narratives. Secondly, when it comes to incentivization and at the board level, if you are going down a track of just taking all of these data points about E and S and G factors as a form of incentivization, as a way to show a company is aligned and mobilized by ESG factors, there is always a risk that your incentivization pulls the executive teams in two different directions. So again, an ESG narrative, as far as you can right from the beginning, try and make it fully integrated so that it's not actually a separate narrative at all. It is core to your corporate strategy. The best way forward that we're finding is listen to what stakeholders, not just your core investors, but stakeholders more broadly are actually asking of the business. Why stakeholders are loyal, what their needs and expectations are, and then to actually, while it's all voluntary, sort of pick and choose which are the most material frameworks and ways of describing how your business impacts and is impacted by broader societal issues. The extent to which you can do that and sort of pull in and start to sort of find ways of disclosing and quantifying that, the easier it will be to build out your core equity story and to incorporate sort of ESG factors before they're regulated. So you're actually getting ahead of the crowd, and that's important as well, of course, because at the moment, I would say that there's actually a golden opportunity for companies to stand out, because if they take the initiative, decide what stakeholders feel is really material to explain why a company is investable, go that extra mile, invest in the resources, in the internal resources and staff that you need, so that you have a solid story to tell. Because even if it does become regulated down the line, you've then gone a lot further to explain that impacts in fairly quantitative terms before it's actually regulated and asked of you anyway. Investors will welcome that. They're all doing this themselves while there is no overarching framework for them to do so. When it comes, everybody will have to do so anyway. So I'd say part of the reason for taking ESG seriously now is to future-proof, if you like, your investment case, because we all know that markets are changing. Markets are going to be wrapping in far more, far broader factors which impact valuation and why a company should be invested in.
Thanks, Brett. So a quick follow-on from that would be, in the world of
Clive, can I just add one piece to that? Because Mark, he talked about tapping finance using a sustainable lens. Now, there's a misconception at the moment, if you read the headlines at the moment, because ESG's been pulled into culture wars, that, ESG is all over it. But actually, when I talked to, and last week I was talking to big European investors in this ESG space, where they are, what they're saying is we've pulled back a bit, right? Because we now really want to focus on the science-based people and the pragmatic companies that are going to drive impact. So it's not that the capital is not there for either lending or investing. It's that people are allocating in a lot more science-based way. Therefore, that's where the opportunity comes for what I think is mid-cap companies. Probably have a great opportunity in this space who can be pragmatic, put in the science and move quickly. So from that company level, the opportunity to get it right lies there for me. Sorry, you go on.
No, that's great, Jonny. I was just going to ask Brett if he's, in the world of M&A, mergers and acquisitions, are you seeing, a lot more focus on ESG value drivers and indeed, the related diligence that goes with that, either from potential acquirers, but also businesses, looking to lock in value and supporting their ESG stories?
Yes, I think there is definitely an emerging trend in what are terms of ESG activism, where companies are being pulled up on the inertia, if you like, in responding to climate change issues and broader issues. And so you're seeing that at AGMs in voting resolutions and so forth. But to the extent that companies are not responding, yes, you're beginning to see acquisition activity that capitalizes on the valuation sort of disconnect that begins to emerge between companies that are not helping investors to price broader environmental and societal factors. And I think this will continue, and you will see hedge funds actually looking to sort of actively either bid for or adopt sort of hedging activities that will drive the price in the right direction if the market itself doesn't do so naturally.
Great. So thanks for that, Brett. Jonny, what are some of the things that companies should be thinking about in terms of their 22, maybe 23 disclosures, given that a lot of what we talked about is it's a long journey, but you've got always very short-term disclosure requirements, etc. So what are some of the key things that you would advise them to be considering?
So what I would say is learn from what's happened before. So there is some case studies, without naming it, there's a big global coffee company that came out with a big ESG disclosure, which essentially meant that from 2030 to 2040, when you compare the data they released in their ESG report to their own financial reports, when you cross-marinate it, they essentially declared they'd be trading at 7% less. So in an overall business capacity, that doesn't make sense, right? So it's not good for investors to see that. I think, look what's there. So we have a series of standards and frameworks. So we've got science-based targets, we've got carbon, you can measure that. You got TCFD, you got TNFD, you've got the IFRS work, you've got the ICAS work, and you've got the GRI for the governance. So those are good tools. And in my mind, those are the tools that are going to kind of, my feeling is those have been the selected tools, right? Everyone's settling around those. Be patient, it's going to take time, right? Because globally, companies going to get a science-based target now, and I was talking to someone who works in that business. Globally, the demand for people doing a carbon 1, 2, and 3 measurement and getting it through the science-based target, there just simply isn't enough people in the world to do the amount of companies looking for it. So it is going to take time. What I think is, in terms of company readiness, understand that the valuation that investors and markets are putting on you, it's changed to what I would say before you had 10 standard topics, which was use of capital, strategy, capex, what you're doing at your revenues, EBITDA, stuff like that. You now add 11 topics, which we could call ESG, which are materiality, your science-based, how you see your forward-looking risks and opportunities. So that's the question of going, for example, you are a European coffee producer, but all your coffee comes from Ethiopia, right? You might have great sales in Europe and everyone's buying your coffee, but if you can't give a good narrative about how you're going to protect your supply, i.e., what's climate going to do to the coffee in Ethiopia that your business is based on, how viable are you as a business? So think through it like that. I think it's important to, don't get trapped in utopian thinking. And by that I mean is, this is iterative, okay? I love the way that you guys in your report, you actually lay it out very well, but the impression I got with ICAS is, you're set up for a long journey, and it is a long journey that we're all going to learn along the way. So, don't feel the pressure to outdo other people. I think when you're going to talk to people like Brett, they'd much rather hear you say, we have started our science-based targets. Our initial modeling on capex and valuation is here. We've got the first impression of our TCFD, and we're going to come back to you on a quarterly basis, and we're going to report, will that do your work? Because I think investors are willing to have those conversations. And as I said in my initial point, I think a lot of people have been scarred by the ESG ratings world, and we're in a moment of pivot. So being honest, pragmatic, and practical is probably the best way to get ahead.
That's great, Jonny. Good. Do we have any questions coming through, Claire?
We do indeed, and it's a three-part question actually. So part one, is there a consistent view of the investment community on sustainability reporting? I think that's probably something that everyone can comment on. Part two is about geographical differences. So are there any nuances across regions or even amongst different kinds of UK investors? I think everybody's touched on the fact that some investors are further ahead with this than others. And so what that results in is just, you know, a difference of expectation. And then the third question, which I suspect is one for Mark, are the current economic conditions having any impact on investors' focus?
Well, that's great. There's three questions and I have three experts around me, so I don't need to answer any of those. So maybe we kick off in reverse order with Mark on the current economic conditions, things to consider there, Mark.
Yeah, I think it's a very valid question, and from our perspective, from Cranswick's perspective, current economic challenges don't have an impact on our approach, but and we'll be publishing our annual report in a couple of weeks' time. And just, you know, if anybody reads it, you'll see the huge amount of work that's gone on in terms of TCFD reporting for the first time. That is a big chunk of work. And what I would say with any of these pieces of work is don't underestimate how much time, effort, and involvement they require to start and plan early. And it was a 12-month project for us, really sort of warming up and getting everything ready for TCFD. The scenario analysis and the validation of those scenarios is pretty intensive. I think in terms of the investor community, I've just been through our annual results roadshow. We announced our results back towards the end of May, and I think the honest answer is it's with everything that's going on in the world, both economically and geopolitically, that has diverted investors' views and probably sort of thrown them off track. I think I had less questions this time around on this topic than I have for the last 2 or 3 years, and I guess it's understandable. I think the important thing is, just because it's not front of mind for investors right at the moment, and you can see with share prices and markets bouncing around as they are, that they do have that there are challenges for corporates and the investor community alike. But that doesn't mean to say it's any less important, and certainly shouldn't be something that gives you any thought about sort of easing off on you know taking a foot off the pedal. This is here to stay, and I think you know, in 6 months' time it could all look very different, and you just got to keep moving forward at pace. Yeah.
Thanks, Mark. So I'm going to ask Brett to address the question about, is there a consistent view of investors on sustainability reporting, and then we'll flip to Jonny, who can talk about possible geographical considerations. So Brett.
Yeah, sure, thank you. Yeah, two points on that to help sort of companies sort of frame their thinking. Increasingly, I think what we're seeing are investors sort of coalescing around sort of, you know, quite sort of grand investor alliances to get consistent views from an engagement perspective of what expectations are of companies, certainly around climate emissions, sort of net zero strategies. So I think that's point one. You know, companies can see a broader sort of consistency of thinking if you look at what the frameworks these investor alliances are encouraging their members to vote around. Beneath all of that, you know, investors, I think, below all that sort of broad consensus, I think investors are trying to just sort of differentiate themselves in terms of the specific ways that they will engage, that how they will vote and act on different issues. So it's still incumbent on companies, I think, to know their investors. One fairly easy way of assessing the sort of the range of expectations is to pay increasing attention to the engagement agenda letters that are sent around to companies at the beginning of each year. You know, the very sort of public letters that Larry Fink puts out are a good sort of global framing, I think. And there's always interesting sort of guidance on how the investment community's going to, again, sort of coalesce around those big issues. But also, every single company will get letters directed to the chair, to the chair of the company, explaining what the investment agenda is likely to be, what the scope of engagement issues are likely to be. And we see this now. It's increasingly about putting sort of climate risk and climate issues, transition plans at the top of the list. Biodiversity considerations are rapidly coming down the track. As issues as well, and these are ultimately going to become sort of voting issues that investors will pursue with companies in order to justify their continued support for the company, but also sometimes to actually sort of take a position or enlarge a position. So the evidence is out there. It's just a case of sort of joining the dots. But I think those are two good ways of sort of cutting through the noise and prioritising from a corporate's perspective what's relevant to enhance that investment case for the year ahead.
Thanks, Brett. Jonny? You're on the question around geographical differences, if any.
Geographical differences. I think this is interesting, a very important piece as well, because two things. We've seen Elon Musk doing a whole lot of tweeting about ESG ratings, and then that drives people to say to me, oh, ESG is all over and everything like that. But we need to integrate the data and what's really happening a little bit more. And politics plays a big part in this. So there's three pieces of consultation that are going to really shape this. You've got the SEC, you've got the work that the ISSB and IFRS and the European disclosure standards. Now, I don't want to go into jargon, so what I'll talk to Claire about, see if we can put up a blog post later this week to give people more details on the significance of them. But those are three global pieces of consultation that will set disclosure. Now, when you look politically at this, in the US, you have a big, very bipartisan backlash against people like BlackRock going in and asking ESG questions in Texas. What I see happening there is the work the SEC will do because of politics. You will have a pushback with the large chance that Republicans will get in, right, in the next election. Now, if that happens, you're going to see ESG flows coming to Europe. Europe is a lot more dedicated to this. And when you speak to people in the Commission, they are really driving at this. And Europe sees it as interesting enough with China. They see this as an economic driver. So they see jumping into renewables, jumping into getting green revenues for the circular economy. This they see as a big moment to bring the future Europe forward. So I'd be keeping an eye on Europe. And when you speak to regulators in the FCA and in the UK, because of our political environment in the UK, they can't say it out open, but they do say it quite a lot. We do like what Europe's doing. So I think you'll see the UK following Europe. So high level. Don't get distracted by the politics. Do dig into these consultations. Do take the standards and keep an eye. Don't be distracted by the Elon Musk people, right? And the big headlines coming from the US, because it's incredibly partisan. Follow the money. The money's going to flow to Europe, and the capital, like I think Brett says, the capital is still going in. Like I said before, when I speak to people with the big, 1 billion ESG funds, they're looking for small, medium businesses that are going to be a key part in the circular economy. So that's how I feel it's going to go.
That's great, Jonny. Thanks very much. And thank all three of you for responding to the question. So we're approaching the last 10 minutes, and I know that Claire's reserved the final 5 because she'd like to give some commentary, give a recap. So in the next 5 minutes, just quickly going through Mark, Brett, and Jonny, all of this could be viewed as pretty overwhelming. If you're sitting on a board, you're sitting in a management team, it was already pretty challenging before we hit COVID, war, etc. And so, any sort of words of comfort, words of quick advice to boards and management to help maybe take some of the stress out of the system. I'm going to start with you, Mark, and then go to you, Brett, then Jonny. Mark. Words of wisdom.
Yeah, well, I'm not sure how wide they are, but I think from my experience and our experience, I think just recapping on one or two of the points I made earlier, firstly around that sort of cross sort of total engagement from board down to business unit, down to the individuals across the business is key. And then joining all those strands up, because you have a lot of there's a lot going on here. I think like any other project, treat it as a project, build it into strategy, align it to your business strategy. That's key. It can't just sit out on a limb. We don't report a separate sustainability report. It's very much embedded into our ARA. We do have a separate microsite on our website, because there's a lot of things changing, fluid. There's a lot of fluid change. And then, like all projects, it's got to be resourced. There's a huge amount of time and an effort required to move these projects forward. And just assuming that everybody can do it on top of the day job is a big ask. So it's about being realistic what you can achieve, and breaking these big, chunky, 20-year targets down into meaningful and deliverable components, and then understanding as well what is the investment. In our business, there is capex, and you've got to be able to fund it and plan it in, and overlay that onto business as usual as well. So it's really about resourcing, embedding, and aligning, I think, are the three words I would pull out.
That's great, Mark. Thanks very much. Brett?
Sure. So I would say that it is all about, well, first I would say don't feel overwhelmed to any company listening. I would think it is about identifying what matters to you as a business beyond demonstrating financial performance and the prospects of the business. It involves identifying what else is needed to explain and reinforce why your addressable markets will grow despite a worsening climate crisis, despite all of the issues of biodiversity, and what you can do as a business to demonstrate your relevance to an increasingly broader pool of investment capital that wants to support businesses which are not just performing in more sort of chaotic and less predictable markets, but also those that can actually demonstrate leadership. How can you demonstrate that you are part of the solution, that you are driving and enabling a just transition? So I would say it's about firstly, listening to your audiences and your stakeholders, identifying the sort of set of material issues that are core to their shifting expectations, and ensuring that you have a voice. It can be a qualitative voice for now, but look and use all of these different sort of tools and frameworks that we're seeing to begin to build as quantitative a way of describing that, so that the capital markets can make cross that bridge and actually back what you're saying from an investment perspective. Just bear in mind that what the entire financial system is trying to do is reallocate global capital to ensure that we avoid as many of these existential crises that are fast coming down the track. So it's about understanding how you as a business can explain how you remain relevant to that. That's probably the best way I think I can sum up of how you can sort of capture as much of that broader pool of ESG sensitive capital that we are seeing increasingly within the marketplace.
That's great, but now, Jonny, I did promise Claire 5 minutes, and unfortunately that just leaves you 60 seconds.
So just very quickly, I think Mark has the right blueprint from the CFO piece. I think to add to Brett's piece, essentially what we're looking at is how we value businesses against the backdrop of carbon, climate, biodiversity, and social change. I think in 10 years we won't even use the word ESG. It's just going to be normal. I would also say stick with the work that ICAS and the IFRS are doing, because it's a great iterative blueprint, and we'll all get there in the end.
Fantastic. Thanks very much, Jonny. So, Claire, I've delivered your 5 minutes. I'm going to hand over to you. Thank you to my colleagues on the panel. That was extremely interesting, very rewarding discussion. And over to you, Claire.
I'm incredibly impressed, Clive, with the punctuality. Thank you. I do actually have a final question for the panel, bit of a left-wing one, but hopefully won't take you too much by surprise. It's about this idea of the shift from shareholders to broader stakeholders, public interest. Because if we think about corporate and financial reporting to date has had a very specific target audience. Now, what I hear at the moment is various expressions of value creation, shared value, stakeholder capitalism, which for me are variations on a theme. So I'm interested to just get the panel's views on this notional shift. And, you know, we've touched on some of this already in terms of direction of travel, listening to your stakeholders, don't be derailed by some of the polarized views. But just thinking about that specifically, this notion of the shift from shareholder to broader stakeholder, what is the panel's views on that? And I'm going to actually go in reverse and go Jonny, Brett, Mark.
So I think we definitely do have a shift, right? And I think you're right to say it's a variation on a theme and it depends on your business. I said to you earlier, like you've that downward disclosure pressure from the top. So, you know, investors and finance world people are going to be some of your stakeholders. But what's very interesting is the pressure coming from the bottom, which is the community, the employees, the people in your supply chain, and don't ignore them, because I'm amazed, you know, I'm in my 40s. I'm amazed with the people in their 20s who get in touch with me on LinkedIn. And these are and really smart people who are asking me, will I go into finance or will I go that way? They're the future employees, and they're a lot more, you know, that generation is a lot more sort of connected globally in the world and know very clearly as to what they want, a lot more than I ever did, right? So I think that variation on a theme is very right. What I would say is you need to do a bit of thinking and work through about who these people are. It changes from sector to sector and business to business, but don't ignore it. So do keep your traditional big finance and all those people you want to impress, but don't forget the pressure coming from the bottom.
Brilliant. Thank you, Jonny. Brett.
Sure. So just to build on that, I absolutely support and agree with the shift towards stakeholder capitalism. Frankly, companies should always have been doing that anyway. It's understanding the needs and expectations of all the stakeholders that support and justify why you're in business. The one thing that I would add to that, though, is understand those needs and expectations, but then work to quantify them to the greatest extent that you can, because then you are translating those sometimes qualitative needs and expectations into financial terms. That is what the investment community needs in order for what you say in an ESG narrative to be decision useful. So that's what I would say there.
Brilliant. Thank you, Brett. And Mark. Mark, I think you might need to come off mute.
I knew I'd do it once during the meeting. There we go. So we talk about our stakeholders in our section 172 report, and I think that's where we started. Not with shareholders and investors in mind on this journey. Much more about our customers, our suppliers with very strong links to the farming and agricultural community, and also our communities where our business is embedded. They're what really drive this agenda as much as anything, and then the outputs are really what are of interest to shareholders and to the investment community. So I think it's the two go hand in hand, and you focus on one and forget about the others at your peril.
Brilliant. Thank you all. Well, I just want to say a final big thank you to all of our panelists today, and a very quick plug just before we all sign off. I mentioned at the start that this is part 2 of a programme of events that we're running over the summer. So the next event that we're running is on tomorrow. And the focus there is all about words to action. So this is cropped up in discussion today, but once you've set an ambitious strategy, how do you actually activate that and embed it within your business? So tomorrow you will hear from Zenith, Interface, and a couple of the Emperor team who will be talking about how you empower the workforce, how you engage with your supply chain and customers to drive change. And next week, for those of you who are passionate about disclosure, we have 2 events, one next Wednesday, which is focused on FTSE 350 disclosure, and one next Thursday, which is focused on AIM disclosure. So thank you all for coming and joining us today. Thank you once again to our speakers, and we hope to see you again soon.